Let's explore the income statement in more detail. As we previously talked about, financial statements are truly a communication tool. They are designed to provide information to many types of readers of financial statements. So, as a result, the income statement is consistently broken out into several different and unique sections. Let me take you through those sections in a lot more detail now. The income statement starts at the top with revenues. Now, revenues can also be referred to as sales. It sometimes is referred to as turnover. It really represents the income that a company receives from selling goods or services. Below revenue, we have typically direct operating expenses. So that could be, for example, purchasing inventory. This line is often called cost of goods sold, cost of sales, COGS for short, and it's typically the first expense line item on the income statement. Now, after deducting our direct operating expenses from revenues, we arrive at our first subtotal on the income statement, and we call this gross profit. Gross profit is simply revenue minus direct operating expenses. Now, whatever remains as gross profit can be used by the company to cover other indirect operating costs, interest costs, the costs related to taxes, and so on. Next on the income statement come the indirect operating costs. So this could be things like selling expenses, distribution expenses, administration expenses. Sometimes these are listed as individual line items, but sometimes they're grouped together in just one line item called selling, general, and admin expenses, or SG&A for short. If we take our revenues and then deduct both our direct operating costs and our indirect operating costs, we arrive at our next profit subtotal called EBITDA, or earnings before interest, taxes, depreciation, and amortization. In accounting, the terms earnings, profit, and income really all mean the same thing. So when someone talks about earnings, they're talking about profit. Someone may be using the term income and they're talking about profit. But just be aware that there are many synonyms that are used to refer to the same thing. Next, we deduct depreciation and amortization expense, which relates to the assets we are using in the business. Now, we're going to cover depreciation in more detail later in the course. Our next profit line is EBIT, which stands for earnings before interest and taxes. This line is also sometimes referred to as the operating profit or operating income. I like to think of it as the operating lifeblood of a business. Now, once we go below the EBIT line on the income statement, we then start looking at different types of expenses, such as taxes and debt financing costs. The next direct line is the cost of debt financing. So this includes things like interest expense and bank charges. And after deducting these interest expenses, there's often another subtotal for earnings, which is called earnings before tax. Below that, we deduct taxes and we finally arrive at net income, also referred to commonly as the bottom line. Net income can also be called net earnings or net profit. Whatever the case, this is the bottom line of the income statement, which then feeds into the retained earnings account on the balance sheet. There is one thing that makes the income statement very, very different from the balance sheet, and that relates to time. The balance sheet shows the position of a company at a point in time. You can think of it like a snapshot or photograph on one specific date. The income statement, however, shows the results of operations over a period of time. It captures all of the revenue and all the expenses that occurred during that specific period of time. The period of time reported really depends on the reporting requirements or needs of the company. So, for example, publicly traded companies in North America typically report both quarterly and annually. However, in countries like the UK, Germany, and Australia, to name just a few more countries, publicly traded companies report to shareholders twice a year, semi-annually and annually. When it comes to accounting, there's a really important concept that I want to explore with you now, and it's called the matching principle. Basically, if a company spends money to make money, that spending needs to be recorded at the same time as the revenue it generates. There are two different kinds of entries that accountants make. The first type are regular entries that happen all the time, like recording sales or receiving a payment or paying a cash expense. The second type are what we call adjusting entries. These typically happen at the end of a period. Maybe it's a month, a quarter, or a year. And they're used to make sure that everything is properly accounted for. They're typically not related to day-to-day activities, but instead they're used to make sure that any expenses or revenues that it might have been recorded incorrectly are essentially fixed. Now, in this course, we'll be talking about a few different types of adjusting entries, like prepayments, unearned revenue, depreciation and amortization, and accruals of expenses and revenues. Hey, but don't worry, I'm going to talk you through those terms as we go along. Let's start with something called prepayments. So imagine you're buying an insurance policy. Now, typically, you have to pay for that policy upfront, and it's typically for a year or maybe even more. Since that insurance policy expires over time, or over 12 months, let's say, it can't really be considered an expense right away in the current month. Instead, we need to treat that expense and spread that expense over the 12 months. So when we first pay for the insurance policy, we record it as an asset called prepaid insurance or simply prepayments. And it's because this policy is going to provide us a benefit over the future 12 months. So to start, we record the transaction. We would debit prepaid insurance. Remember, when we increase an asset, we debit it. And we credit cash because we're decreasing cash as an asset. Now, as time goes on, we're going to make adjustments to reflect how the policy is expiring. Let's take a look at a real concrete example so we can all better understand how this process actually works. So imagine again that you've purchased a 12-month annual insurance policy for $12,000. So in a way, this means you're making a prepayment upfront for 12 months of insurance coverage, with each month essentially costing $1,000, just taking the $12,000, dividing it by 12 months. Now, as each month goes by, a portion of that insurance policy expires and can no longer be considered an asset. To account for this, we need to record the expired amount as an expense for that month. This is done by debiting the insurance expense and crediting the prepaid insurance account. It's important to note that this adjusting entry affects both the income statement and the balance sheet. The income statement is going to be impacted because now there is an insurance expense that's increasing, which is going to decrease our profitability. The balance sheet is impacted because the prepaid insurance asset account decreases each month as the insurance policy expires. Let's turn to another example of a prepayment or prepaid expense. Let's suppose this time that a business purchases office supplies in bulk at certain times of the year, simply to ensure that they always have enough to meet the needs of the office. Just like insurance policies, there is a future economic benefit associated with those supplies stored in the office, still waiting to be used. Since the supplies have not yet been consumed, they can't be recorded as an expense when they were just purchased. As a result, when purchases are made, we would record a debit to supplies, which would be an asset account, and a credit to cash or accounts payable. Now, when the supplies are used up, we would then record a debit to the supplies expense and a credit to the supplies asset account, which is thereby reducing our asset by the amount used and showing it on the income statement as an expense. This is done as an adjusting entry because it's not practical to track the use of office supplies on a daily, weekly, or monthly basis. However, someone will perform a count of the supplies at least at the end of the year, or possibly take an inventory and then adjust the expense based on the count of the supplies. Let's put some numbers to this to make this example really come alive. So we're going to assume that a company purchased supplies worth 10,000 for cash. To initially record the transaction, we would credit the cash account with 10,000 because we're reducing an asset, but we debit another asset account that we'll call supplies asset account. These supplies are an asset right now of the company, typically a current asset because we'll expect to use them up in the next 12 months. Now, let's assume that at the end of the reporting period, there are still 2,000 worth of supplies left. We've essentially consumed 8,000 worth of supplies. So we need to make an adjustment to the supplies asset account and also create a supplies expense. So to do this, we record a debit to the supplies expense account on the income statement because we're increasing an expense, but we credit the supplies asset account because we're decreasing that by 8,000. This effectively reduces the supplies asset account to the 2,000, which was determined at the year-end inventory count. We're now going to turn to something called unearned or deferred revenue. It's quite common for customers to pay for goods or services that they will receive at a later date. So, for instance, deposits can be made on houses, cars, event spaces, amongst other things. Let's say an event center rents out its space for conferences. When a deposit is made for a conference, the company is receiving the deposit upfront, but would record this amount as unearned revenue or deferred revenue. This is a liability account on the balance sheet because the company, the event center, has an obligation to provide the good or service in the future. In other words, it owes the service, hence the name liability. At the end of the period, let's say it's a year, the business needs to evaluate the value of their unearned revenue to determine if the obligation still exists or if they've delivered the service or good and then can record that unearned revenue as actual revenue on the income statement. So, for instance, if a deposit was made for a conference center to hold the space for a planned event, once the event takes place, the company reduces the unearned revenue liability and records the amount received as revenue. After conducting this type of assessment, any revenue that has been earned would be taken out of unearned revenue, and that's a debit, and moved to revenue on the income statement, which you may recall is a credit. The final type of adjusting entry I'd like to talk you through is something called accruals. Sometimes companies reach the end of their reporting period, let's say it's 12 months or a year, and realize they just haven't had a chance to record all their transactions. This can happen for a wide range of reasons. I'll just give you one. Perhaps a company is so busy with work that they've done the work, but they haven't had time to prepare and send out the invoices for that work before the end of the year. So even though the invoices haven't been sent out, we still need to reflect the fact that in the current accounting year, we should have earned and we did earn revenue. So what do? We need to record revenue on the income statement and we'll credit revenue, but we also need to debit accounts receivable, recognizing that we have customers that owe us money for the work that we've done, even though we haven't invoiced them for that work yet. This is going to therefore update both the income statement with an increase in revenue, and it's going to increase the balance sheet with an increase under current assets under accounts receivable. The same thing can happen with expenses. We may have expenses that we incurred, but they haven't been recorded yet. Either we're too busy or maybe we haven't got the invoice yet from our vendor or supplier. But even though we haven't actually maybe received the bill from our supplier, we still need to record the amount of the expense owed on our financial statements. The entry that we would do to reflect this is we would accrue expenses, which would be to debit an expense account related to whatever the expense was, utilities or telephone. That would increase our expense, but we'd also credit what we owe to our suppliers. And we call that accounts payable, and that is a current liability. Now let's record some transactions where we have to use the accounting matching principle. I have two transactions that I've created for us to work through for a company that I've called Pearson Inc. Let's look at those transactions and work through them together. Okay, so the first transaction, we purchased a 1-year software license for $6,000 on November 1st of the current accounting year. Now, the payment was made in full on November 1st of the current year. So here's the challenge. The expense that relates to this year is only 2 months out of the 12 months. And using the matching principle, we only want to record an expense of 2 months, not 12 months. However, we paid the cash up front. So let's actually do the journal entry together. Now, cash is going down on November 1st by $6,000. When we decrease an asset, recall that's a credit. Now we have to explain or match the expense to the current year and make sure the expense that isn't related to the current year is recorded as a prepayment. So 6,000 divided by 12 months. Let me just move over here. Is 500. So I'm just going to go 6,000 divided by 12 months. And we have 2 months of the expense relates to our current accounting year. That's November and December. So I'm going to go divided by 12, but times 2. Now at December, we're still owed 10 months of the license. We're owed that. So that's an asset. And we call that asset a prepayment. And that's going to be equals, we're just going to take the 6,000 divided by 12, which we know is 500 a month. And we are owed 10 months of service. Congratulations, we've done our journal entry, our debits match our credits, and we've also stayed true to the matching principle. Now let's do the second transaction. The second transaction is we paid $1,300 of interest expense for the month of December of the current accounting year, but we paid it after the year end on January 3rd. Now, interest is paid at the start of each month to cover the interest expense incurred for the previous month. So here we have to record an expense for the current year, even though we haven't paid that expense. So we're not going to deal with cash in this journal entry because in the current year, we haven't paid or received any cash. But we do have to record the expense because the expense relates to the current year, in particular, the month of December. Now, recall that when we increase an expense, that's a debit. Now we need to know what's the other side of that transaction. Now, it's something we owe. We haven't paid yet. And we call something we owe that we haven't received a bill for yet, or we haven't paid, an accrual. And we'll put $1,300 there. Our journal entry balances, our debit and credit balances, and we stayed true to the accounting matching principle. Okay, now we have a couple more transactions to practice the matching principle with. I encourage you to try and do it yourself first, and then when you're ready, hit play, and I will debrief this with you. Okay, so the company I've made up, in this case is Laurie Inc. There are 2 transactions. We need to make sure we are using that accounting matching principle. And the first transaction, let's read it. We purchased a 1-year property insurance policy for $12,000 on October 1st of the current accounting year. So we have that insurance policy covering us for October, November, and December, so 3 months of the current year. Now, the payment was made in full on October 1st for the full 12 months. So we know that when we decrease an asset like cash, that's a credit. But now we need to use the matching principle. We're not going to record the total $12,000 expense in the current accounting year because we're only enjoying 3 months of insurance coverage. So I'm going to take that $12,000, divide it by 12, which works out to an insurance cost of $1,000 a month. And we had 3 months of insurance coverage in the current year. So that's the expense using the matching principle. However, we're owed another 9 months of insurance coverage next year. Because we are owed that, it's an asset, it's a prepayment asset, and the amount of that is going to be $12,000 divided by 12. That's the monthly cost of $1,000, but we get 9 months of coverage next year. Our debits match our credits, and we've used the matching principle. Okay, now what we're going to do is we're going to do a utility expense. Here we paid $2,500 of electric utility expense for the quarter ending December, but we paid just after the year end on January 10th. Typically, the utility expense is paid at the start of the month following the end of the quarter. So here we have an expense relating to the current year, but we haven't paid any cash. So we're not going to touch cash, but we have to record an expense when we have an increasing expense. That's a debit of $2,500. So we need to have a credit somewhere to balance that out. And it's something we owe. We still owe that utility expense at year end, even though we might not have even got the bill. We know that we incurred that expense. That's an accrual. It's a liability. Our debits match our credits, and we've honored the matching principle. Another incredibly important accounting concept that involves adjusting entries is something called depreciation. Remember in our original balance sheet example, we purchased equipment with a value of 80 and recorded it as property, plant, and equipment under non-current assets. Let's now assume that the equipment has a useful life of 4 years and that we're going to use that asset very evenly over those 4 years, and that at the end of the 4 years, we believe the asset will have a value of about 30. In other words, we'll be able to sell that used asset for 30 in the market. We call that a residual value or scrap value. You can see that we have an expense that needs to cover multiple years. So we need to spread the cost of this expense over the asset's useful life to ensure we're still aligned with the matching principle. So let's see how we do this. We can spread the cost or expense of an asset used for more than 1 year using several different approaches. The most common depreciation expense approaches are straight line, units of production, and double declining balance. To calculate depreciation expense in each of these approaches, we need to understand several factors such as the cost of the asset, its expected useful life, how we're going to use that asset, and its salvage value. A business needs to typically select the depreciation expense approach based on which approach most closely matches how the asset will actually be used in the business to generate revenue. Let's now explore each of these 3 approaches in a bit more detail. By far, the most common depreciation approach out there is something called straight line depreciation. This approach assumes that the asset will be used in the business really consistently over its useful life. So here we have an example of an asset that costs $25,000, has a useful life of 8 years, and is assumed to be worth nothing at the end of its useful life. We're assuming we won't be able to sell it for anything. Dividing the $25,000 initial expense by an 8-year useful life gives us a consistent depreciation expense of $3,125 each year. Let's now do another example where we actually do have some scrap value. So let's say we purchase the equipment for $80,000. We expect it to have a useful life of 4 years, after which we think we'll be able to sell the used asset for $30,000. So in this instance, the cost of the asset for the business is not $80,000, it's only $50,000, as we'll be able to sell the asset for $30,000 at the end of its 4-year useful life. So we only take the cost of $50,000, not $80,000, and spread that evenly over 4 years, which would give us an annual depreciation expense of $12,500. Let's look at how the journal entry would work for this transaction. We know already that increasing an expense is a debit. As depreciation expense is just that, we're going to debit depreciation expense. Now we need to look at the credit side of the journal entry, and we're going to create a new account called Accumulated Depreciation, which sits on the balance sheet. We call this type of account a contra account, or a contra asset account in particular, where contra means against. In the case of depreciation, what we're going to do is set the balance in the accumulated depreciation account against the corresponding property, plant, and equipment account. Let me now take you through how this looks each year from year 1 to year 4. Now, the accumulated depreciation contra asset account is going to sit right on the balance sheet next to the corresponding asset account. So you can see that we still show the original cost of the asset, but we net off depreciation of $12,500 to give a net balance of $67,500. This balance is referred to as an asset net book value, where net means after deductions. I also like to think of the financial statement reader. So another way we can kind of explain this is think about it this way. What we're trying to communicate to that reader is that of the original 80,000 we spent on the asset, we have expensed so far 12,500, but we still have another 67,500 to expense in the future. Let's now move to year 2. Because it's straight line depreciation, we're going to expense another 12,500. And the journal entry is going to be debit depreciation expense. Remember, we're increasing an expense, so that's a debit. So 12,500 goes there, but we're going to credit the accumulated depreciation contra asset account, also with 12,500. This is going to increase that accumulated depreciation account balance on the balance sheet from 12,500 to 25,000, which is going to also reduce the net book value of the asset now from 67,500 to 55,000. If we look forward to the ends of year 3 and 4, again, we're going to expense 12,500 each year with the same journal entry I just talked you through. Now, recall that at the end of year 4, that's the end of the asset's life, and we're going to sell that asset for 30,000, which matches the net book value on the balance sheet at that date. Now, let's look at another popular depreciation approach. It's called double declining balance. Now, this method is really the most appropriate where an organization expects to get more value from an asset at the beginning of its useful life. The equation to calculate depreciation using this method is 100% divided by the useful life of the asset, multiplied by 2, which really doubles the decline, and then we multiply that by the opening balance or opening net book value of the asset. So here's the same asset we saw before that cost $25,000, has no scrap value, and will be used for 8 years. Let's calculate depreciation for just the first year. Remember, the formula is 100% divided by 8, which is the useful life of the asset, multiplied by 2 to create that double decline, and then multiplied by 25,000, which is the opening balance. This gives a first-year depreciation figure of 6,250, which is double the depreciation expense of 3,125 that we calculated using straight line. Our final depreciation approach or method is called the units of production method. This approach expenses an asset based on its exact usage. The more the asset is used in a period, the higher the depreciation expense. So, for example, taxi companies could depreciate their vehicles based on their expected mileage. An industrial-grade coffee machine could use numbers of shots or cups of coffee. Given that those cost drivers are also used to determine the repairs and maintenance costs of those assets, the units of production method often makes sense. Let's use the same example we've seen already with an asset costing $25,000, 0 scrap value, and an 8-year life. However, for this method, we also need some additional information. Let's also assume this piece of equipment will produce 50,000 widgets over its useful life and is expected to produce 2,000 units in the first year of use. The first thing we need to do is calculate a percentage of widgets this year versus total widgets. So if we take 2,000 for this year divided by the total of 50,000 over the useful life of the equipment, that works out to 4%. In other words, we're saying we should expense 4% of the asset in the first year. Now, 4% of 25,000 works out to 1,000, which will be the year's depreciation expense. Okay, let's actually calculate depreciation together so we can practice getting the calculations right. I encourage you to speed me up or slow me down and work through this with me. And then I want you to have a go on another spreadsheet, try to complete that, and then I'll debrief it with you. So let's work through 3 types of depreciation and the calculations. Whenever we're looking at calculating depreciation, we typically need to know at least 3 things. We need to know the cost or purchase price. In this case, we're going to assume the purchase price was $25,000. we need to know how long we expect to use the asset in the business. We call that the useful life. And in this case, we're saying it's 8 years. And then we need to know if there's any scrap or residual value to that asset at the end of its useful life, in this case, 8 years. And we're going to assume that it's 0. Now, what we then need to do is we need to spread the expense of the asset over the useful life. Again, we're using the matching principle here. So what we typically will do is we'll start with the opening balance, which is $25,000. And then we have to calculate the depreciation expense. Now, I'm going to do it the long way, and the formula is on the right, but it is equal to the cost, always minus the scrap value. And I know that's 0, but for completeness, let's put the full formula in. We're going to then divide that by its useful life. Now, one thing I want to do is I want to lock that down. So I'm going to just hit F4. I'm just going to get those dollar signs in so I can copy it down. But you can see the cost is $3,125. Now, let's imagine, though, that the scrap value at the end of 8 years was, I don't know, $5,000. Our formula then updates, and basically we're saying there's only $20,000 of expense over 8 years, so we'll divide that up, and the amount each year will be $2,500. Okay, so let's put that back to 0. Our closing balance on our balance sheet is going to be the opening balance, simply minus the depreciation expense. Now, our opening balance is going to be the closing balance. Our depreciation expense isn't changed, so I just did Control D, fill down. And our closing balance will be the opening balance minus the depreciation expense. And then I'm going to highlight this. I'm just going to copy it down. I'm using the shortcut Control D. And you can see, and the trick to make sure you got the calculation right is that at the end of the useful life, the closing balance should be the scrap value or residual value, which in this case, we've already said is 0. Let me change that again to 5,000. And you can see the depreciation still works because at the end of the useful life, the value is 5,000, which is what we expect to sell it for. Okay, so let me set that to 0. Now let's move on to double declining. Here we have the same purchase price, scrap value, and useful life. The opening balance is going to be what we first paid for it. Now the depreciation expense, the formula you can see on the right. And what we want to do is we're going to go equals, and I'm going to go 100% divided by the useful life of the asset. I'm going to use F4 to put dollar signs and lock that reference so I can copy it down. Then I'm going to multiply it by 2, and then I multiply that by the opening balance. We have 6250. Our closing balance is simply the opening balance minus the depreciation expense. Our opening balance for period 2 is the closing balance for period 1. I'm going to copy this down, Control D, shortcut for fill down, and I'm going to go Control D again. And then what I'm going to do is I'm going to highlight row 32, and I'm going to highlight down and just go Control D to complete that depreciation expense using the double declining method. Now, one of the things to note, recall, is that we're using this where we think more of the asset is used up in earlier years. So we're trying to spread that expense based on how we expect to use the asset. Okay, so now we've done double declining. Let's look at units of production. I'm just going to scroll up. Okay, so again, same type of basic information. Purchase price is the same, scrap value is the same, and useful life is the same. Our formula is here. Let's fill this in. And the way we are spreading this expense is basically on how the equipment is going to be used in production. So what we're saying is there is going to be 50,000 of units produced over 8 years, and we expect 2,000 units to be produced in year 1 or period 1, 3,500 in period 2, and so on. We've also already done the calculation of what percent of total product or units are represented by each year. So 2,000 divided by 50,000 is 4%. Or in other words, 4% of our total units will be produced in the first period. So we're going to take 4% of the expense. So the opening balance is always going to be the purchase price to begin with, but our depreciation expense is going to be the number of units produced divided by the lifetime number of units, but we've already done that. That's 4%, but we're going to multiply it by the cost minus the scrap value, which we know in this case is 0. And we're going to record a depreciation expense of 1,000. Our closing balance is simply the opening balance minus the depreciation expense. And our opening balance is the closing balance from the period before. I'm going to copy down, Control D, the depreciation expense for period 2. Why is it more? It's because 7% relates to that year. Our closing balance, I'll copy down, Control D, and then I'll copy this all down. Very much like our first depreciation exercise, we know we've done this right if at the end of the 8 years, the balance here matches our scrap value, which we know is 0. Let's just test that. Let's put scrap value of 5,000 in. And again, you can see our depreciation expense has gone down each period, but that's because we expect to sell the asset at the end of its useful life for 5,000. Okay, let's practice with depreciation expense again. I'm hoping that you have already had a go. If you haven't, I encourage you to pause the video, have a go, and then we can debrief this together. We're going to do the same 3. We're going to do straight line, double declining, and units of production. Okay, so let's start with our straight line. Here we have slightly different purchase prices, scrap values, and useful lives. We have a purchase price of $35,000. We think the asset will be used in our business for 5 years. And at the end of 5 years, we think the asset will be able to be sold for $2,725. So our opening balance when we buy the asset, of course, is the purchase price. Our depreciation expense for straight line is relatively straightforward. We just take equals the purchase price. Make sure you put those dollar signs in there. I use F4 minus the scrap value, which is really representing the expense that we need to spread over the useful life. And then we're going to divide it by the useful life. And again, F4, make sure those dollar signs are there, and then we can just copy it down. So our depreciation expense is going to be $6,455. Our closing balance for the period is simply the opening balance minus the depreciation expense. The opening balance for the next period is the closing balance from the previous period. We can copy down the depreciation expense. We know it's straight line, so it should be the exact same number. And then we can copy it all down. And we know we've done it right if at the end of the useful life, the amount that's the closing balance matches the scrap value, which was $2,725. Now let's do double declining. Let me scroll up. Okay, so with our double declining, our opening balance always starts with our purchase price. Our depreciation expense, though, equals 100% divided by the useful life. I'm going to put dollar signs there to lock the reference, multiplied by 2, and then we're going to multiply it by the opening balance. And I'm not going to put dollar signs there because I want that cell reference to move. Our closing balance is the opening balance minus the depreciation expense. The opening balance for the next period is the closing balance for the previous one. I'm going to copy that down, Control D, copy that down, and then I'm going to copy this all down. And you can see at the end of the period, of period 5 in particular, we do have a closing balance. The key thing with double declining that you might have noticed in the previous exercise and this one is it doesn't necessarily match the scrap value, and it's because of the calculation itself and how we expense more early on. However, for units of production and for straight line, we always know at the end of the useful life, the amount that we see as the closing balance should be the scrap value. So now let's go to units of production. Here we have 6% of units produced in period 1, 10% in period 2, and we want to spread the expense of the asset based on how many units or percent of units are produced each period. So our opening balance, again, at the start is always our purchase price. Our depreciation expense is going to be 6% of the expense, which is, of course, the purchase price, lock down that with dollar signs, minus any scrap value. Our closing balance is our opening balance minus the depreciation expense. Our opening balance for the next period is the closing balance from the period before. I can go Control D, fill down. Control D, fill down. My depreciation expense is significantly more in period 2, but that does make sense. It's 10%. If I copy this down just 1 year, again, that year it's 6%, so it should match our period 1. I'll copy the rest down using Control D. I know we've got it right because the scrap value as the closing balance is 2725. I'm super excited that we're now going to build on what we've done, and we're going to build both an income statement and a balance sheet for a company that I'm going to call Cobble Hill Inc. Now, the transactions that we're going to record are in row 7 down, and there's quite a few, so it's going to take us a bit of a time to go through this. Then we have our balance sheet in row 32, and then we also have our income statement starting in row 73. Let's see if we can get this all working together. Here we go. So we're going to issue common shares for 1,000. So we're going to have cash of 1,000. Oops, I'm going to put an equal sign so I can record all my transactions and see those transactions if I look in the cell. And our common shares, oh, there was already a number in there. That should be 1,000. Let's get that in there. Our balance sheet balances, and this transaction doesn't hit the income statement, so we're good. Now we borrow 400. Where it says repays loan, but there's nothing there, but we're paying interest. So we're borrowing 400, but paying interest is an expense. So let's do the borrowing first. So we borrow 400. So let me get up here. Our cash is going up by 400, but we also owe, and we're going to assume it's long-term, we owe 400 to the bank. Our balance sheet balances. That transaction doesn't hit the income statement, but now we do have one, and we're paying interest. And I'll just remind you, we are paying interest of 24. So remember, we are increasing expense. That's a debit. Now we're going to record it separately on the income statement, but we need to also make sure that anything happening in the income statement does still feed through into equity, and in particular into retained earnings. So let's actually scroll down here, and we have interest expense, and that's minus 24. And then we have cash going down by 24. Now you're going to see that our balance sheet isn't balancing by 24. And that's because there's one critical thing missing. We haven't plugged the income statement into retained earnings. So what we need to do is make sure that in cell E61, we link the income statement, in particular, the very bottom, what's being retained, to and into the balance sheet. And when we do that, you can see that our balance sheet now balances. Okay, let's keep going. We buy property and equipment, or property and plant, for 900 with a 10-year estimated useful life. And that's because we're going to calculate depreciation on this. But let's just start with the property. We are decreasing cash by 900, but we are increasing another asset, which would be a debit, recall, by 900. Now, let's actually talk about that depreciation. We're going to assume straight line depreciation. We're going to assume zero scrap value. So all we need to do is to calculate the depreciation, take 900 and spread that expense over 10 years, which is going to be 90 a year. Now, what we're going to do is there's two aspects to that. We're going to have to adjust the value of the asset. But we also have a depreciation expense, which is on the income statement. So let's capture that depreciation expense, minus 90. And let's just make sure, you probably can see it here. Here's the check. Good, our balance sheet is still balancing. Okay, now we're going to buy inventory for $350, but some of it's on credit. So we're paying $320 in cash, which means $30 is still owed at the end of the year to our suppliers or accounts payable. So we're buying inventory, but I'll do the cash first. Minus $320. but we have 350. But we also have accounts payable now of 30. Let's make sure the balance sheet still balances. Good. We've done those transactions correctly. Now, what I'm going to do is go to the next bit, and now we're going to sell the inventory for 510, and we're going to get cash received from sales of 430. Okay, so recall, therefore, the difference is going to be accounts receivable. And if you want to figure out what that accounts receivable is, it's just going to be the 510 minus the 430, which is 80. So let's do that first. We're going to get cash in of 430, but we're also going to have 80 of accounts receivable. Now, we're going to be out because we haven't recorded the revenue on the income statement. The revenue will then feed down to net income, then into retained earnings, so our balance sheet should still balance. But let's actually make sure that revenue is in, and the revenue, recall, is 510. So I'm going to capture the revenue. And we then have retained earnings at 396, which means our balance sheet is still balancing. We haven't finished that, though, because we have to actually record the expense of the inventory. And we're assuming in this case, we're selling all the inventory. There's not a percentage there. And so I lied, because of course there's inventory left at the year end of 60. So let's actually make sure that we take off the inventory. So that means we have 350. We know there's 60, so we've sold 290. So what I'm going to do is I'm going to put an equal sign there. I'm going to make sure I'm going to minus 290. So we're decreasing an asset. That would be a credit. We know that there's 60 left at year end, but that 290, remember, is the expense or the cost of goods sold. So our balance sheet's not going to balance. It's out by the 290 because we haven't recorded the cost of sales on the income statement. So let me put the 290 in there. And you can see our balance sheet balances. We're starting to get more of a complete income statement, but we're not done yet. There's a couple of other things we need to record. So we pay expenses of 40. We're going to be paying tax at 30%, and we're paying a dividend. So the 40 of expenses, let's do that. That's 40. I always start with cash. But we have expenses of 40. Again, our income statement is feeding through correctly into our balance sheet. We know that because the balance sheet continues to balance and the accounting equation holds. Now, we're paying tax at 30%. So what I've done here is I've linked it to E90. It's because what we're going to do is we're going to just use a formula here. We're going to go equals minus, because we want it as an expense or a negative sign, profit before tax or earnings before tax times 0.3, which is 30%. That's 20. You can see there's the 20 there. But our balance sheet, let's check if our balance sheet balances. It doesn't. Why not? It's because we haven't actually deducted the cash. So now let's deduct the cash. Oops, and let me get that on the screen. We're going to go minus 20. And hopefully now our balance sheet balances, and it does. Good. Okay, so now we're almost done. There's just one more thing to do, and that's the dividend. So let's look. We pay a dividend. That's out of cash of 30. So let's reduce the cash by 30. And then what we're going to do is actually record that dividend, because net income is 46, but what profit is retained in the business is after we pay out dividends, which is 30. And so the retained earnings are 16. Let's just check the balance sheet balances. It does. Congratulations. You've recorded not only a balance sheet, but also a separate income statement. Now, I'm even more excited to take you through year 2, because what we're going to have to do is build on year 1. In particular, we're going to need to start with the balance sheet, and we need to recall that the balance sheet is a snapshot at a point in time. So at the end of year 1, we actually have the balance sheet, but those account balances become the opening balances for the next period or year. So before we record any transactions for year 2, we need to transfer the account balances, the closing balances, to make them the opening balances for the new year. And we can do that by just using equals and linking the two together. And I'm going to go Control C, and then I'm using Pay Special. With Pay Special, you can choose, whether you want all, but I just want the formula. I don't want the formatting, for example. So I'm just going to hit OK. And then I'm going to, instead of doing Pay Special, I'm going to hit F4, which is just repeat command, as a quick way to get these all filled in. So now our closing balances from the previous year are our opening balances for this year. Now we can start recording transactions. So let's actually work through those. The key question to ask always, is the transaction going to hit the balance sheet or the income statement or both? So here we have a loan being repaid. That means our cash is going down and the loan's going down. So that won't hit the income statement. So let's actually capture that. Minus 100 of cash, and the loan goes down by 100. Balance sheet balances, we're good. Now let's do the interest expense. Remember, expenses are on the income statement, but it's also going to hit cash. So let's reduce our cash by 18, but also let's record an interest expense of 18. Now you're going to see that there's a tax expense already being recorded here, but let's actually delete that for now. And I'll tell you why. We want to make sure we are linking our retained earnings or our income statement back into our balance sheet. So we're going to have to go the opening balance, but plus whatever our retained earnings are for our current year. Good. We get the balance sheet to balance. Total assets equals total liabilities and equity. Now what we're going to do is we're going to do another transaction. Now, one of the things we may want to do is think about that property, plant, and equipment. It's year 2. We need to actually record a depreciation expense and reduce the value of the asset on the balance sheet. Recall that it is straight line. It's useful life of 10 years. So it's just depreciation expense similar to year 1 of 90. There's no cash involved. So the two transactions are, we're going to reduce the value of the asset on the balance sheet by 90, but we're out by 90, and that's because we have to record the depreciation expense on the income statement of 90, which then feeds through to a new retained earnings number. Okay, so now we've done that. Let's talk about buying inventory. We buy inventory for 100, and we pay 380, which means that we owe 20 to our suppliers or accounts payable. So let's increase the inventory by 400, reduce our cash by 380, and increase our accounts payable by 20. Good. Nothing hit the income statement here. Not yet anyway, maybe later on, but our balance sheet still balances. Now we sell the inventory, so we're going to have revenue, and the cash received from sales is 480, so that's going to be hitting the balance sheet. But we also didn't sell all the inventory because there's still 80 of inventory at the year end. So actually, let's do the sales first. So that's revenue. We're going to go to the income statement. That's going to be 550. Now let's record the balance sheet aspects to that, because what we have of cash, 480, but there's 70 that is owed from our customers. So that means our accounts receivable goes up by 70. Let's just do a quick check. Good. Our balance sheet is still balancing, but we haven't recorded the expense of selling the inventory. Now, one of the things we have to think about is how much of that inventory was sold. And the way we figure that out is by looking at how much inventory is left. So we know the balance sheet has to have inventory of 80 at the end of the year, but we see it's at 460. So how do we get down to 80? Well, clearly what we must have sold is 380. And let's just check. I'm going to minus 380 here. Make sure we end up with 80 of inventory. Perfect. But that's a cost of sales or cost of goods sold. So we're going to have to capture that on the income statement. That's minus 380. And our balance sheet and our accounting equation holds. We're almost there. Now we have a couple of other things to do. We need to pay expenses of 50. Let's do that. Cash goes down by 50. And we have to record an expense on the income statement of 50. good. Accounting equation right here at the top still holds. Let's do the dividend next because that's really easy. Pay a dividend of 5, so our cash goes down by 5. And here's our dividend of 5. Hopefully we're still balancing. Yep, our accounting equation holds. And the only thing we have to do next is record the tax expense. Now, I'm going to just copy the tax expense from the previous year. I'm doing Control-C and just Control-V for paste. Now, we are almost there. You can see our balance sheet doesn't balance because we've recorded the expense of tax, but we also have to deduct that from cash. And we can see that's 4. So I'm going to deduct the tax expense of 4. And we have done it. Let's just do one final check. Our income statement balances. We have a full, the income statement is done. The balance sheet balances. Retained earnings is feeding through. Congratulations. You've just built a full balance sheet and income statement for a subsequent period.